Okay, so thank you everybody for joining, and happy Friday. Today we have an outstanding talk by our friend, this is a friend of the house, Dr. Peter Vanneck, and he's going to talk about how to explore model risks for smarter real estate decisions. So I'm going to introduce him a little bit. He's a senior consultant, entrepreneur, and investor. He runs his own firm, advising clients to make better strategic decisions, primarily in real estate. Right? So he's going to talk about what he does. He's the founder and investor of a real estate boutique company in Belgium, managing real estate development funds and investment in the acquisition, remediation, and redevelopment of brownfield sites. He has a Ph.D. in environmental engineering and a master's degree in real estate management, with additional postgraduate studies in business analytics and data science from the University of Texas. He's an executive professor and guest lecturer at the Antwerp Management School, University of Manchester, and the Institute of Management Technology in Ghaziabad in India and Dubai. He's also certified risk management professional by the PMI and a member of the Society of Decision Professionals, accredited by the Royal Institute of Chartered Surveyors. So thank you so much, Peter, for joining us today. We're lucky to have you here. And well, the floor is yours. This is all being recorded. So thanks again for coming.
Okay, thank you, Gustavo, for this nice introduction. And welcome to everybody to make some time to listen to my talk today. I'm going to cover a few things, since I'm not sure how familiar everybody is with either probabilistic modeling, with model risk itself, and then with real estate financial modeling. So I have put together a sort of a presentation where in the first half I will cover through a few slides basically why we should think probabilistically, and why probabilistic modeling is important for real estate. And then in the second part of the talk, we'll dive into two cases illustrating how we can use model risk for real estate financial modeling. All right, so let's start. Why is probabilistic thinking essential when you try to make good decisions? Yeah. Well, as we all know, with AI and with a lot of data these days, there is a lot of information available to decision makers. There are a lot of consultants active in that area, but nevertheless, what we see is that strategic decisions often fail. When we look at projects, and small and large, we often see that we have mostly cost overruns. Only 0.5% of all the projects hit the targets on budget and schedule. And we see that that happens over and over again across different countries, across different type of projects. That's what Professor Flifbjerg calls this iron law. Projects are over budget, over time, under benefits, over and over again. If we specifically, this is from his book, How Big Things Get Done. If we specifically look at buildings, so real estate, we see that the mean cost overrun for construction projects is about 62%. And of the projects, 39% of those have a cost overrun of more than 50%. And of those that have a cost of those 39%, in fact, the mean cost overrun is 206%. So again, that there is something systematically wrong in the way that we often take decisions, especially in real estate and in construction, and I'll tell you in a bit why. But in general, if we look at decision making, we can clearly distinguish between a deterministic approach, which is more like playing chess, where everything is on the table, where we can think ahead. You make different moves, different options, but we can sort of think ahead what is going to happen. Everything is very clear. Yeah. While in the real life, it's more like poker playing, yeah, where there is a lot of uncertainty, where not all the cards are on the table, where we do not know what is going to come in real life. So we have to include that in our decision making, and that's what the former poker player Annie Duke wrote very well in her first book, Thinking in Bets to Make Smarter Decisions. I definitely recommend that book. It's a nice reading if you have not have it yet. So in order to make better decisions, what we need is sort of a framework, yeah, with different steps. And I'm not going to go through all of those, yeah, but this is sort of the framework that we need to follow in order to make better decisions, yeah, in the long term. Yeah, that does not mean that every decision that you're going to make is going to return a good outcome. Yeah, but if you follow this framework over time, yeah, you will more often get good outcomes from the decisions that you make. Now, what is important is that essential in that process is probabilistic thinking. Yeah, if we look at it, yeah, in the framework, yeah, we see that in the part of information gathering, yeah, we need to include uncertainty. Yeah, so if we gather like cost estimates or numbers for inflation rates or things like that, yeah, instead of only working with single values, we need to work with ranges, with uncertainty. Yeah, that's essential in this framework. And since we then have those uncertainties, those ranges, yeah, we need to incorporate that in one way or another into our reasoning, yeah, in the way that we calculate the outcomes that we're interested in. And that is just what ModelRisk does, yeah, by using Monte Carlo simulation and using probability distributions to incorporate those uncertainty into our reasoning. Yeah. Now, why is that important for real estate modeling? Yeah. Well, I can tell you that in real estate, at least based on my experience, what I see when I talk to, or when we get quotations from construction companies, or when we see evaluations for development projects, most of the time, I would say 95 to 99% of the time, that are still single value calculations. Yeah? And as Sam Savage described very well in his book, it's already an older book, but he stated that plans based on average assumptions are wrong on average. Yeah? So using a deterministic approach is sort of incorporating structurally a bias in your reasoning. Yeah? And especially in real estate, when we're talking cash flows, yeah, and when we're talking net present value calculations, internal rate of return, that are non-linear functions. Yeah? And so that the average or the NPV of the average input is not equal to the average of the NPV of all the inputs. For that, you need to run simulations. Yeah? Furthermore, if you only base your calculations on single values, like most of the people do, if you look at a development project and you say, what's your internal rate of return, you will maybe get a number. Yeah, but as we know, risk or return is always related to risk and vice versa. So that means that even if you have an internal rate of return that looks fantastic, like 20%, for instance, if you cannot relate that to a measure of the risk, yeah, that is not going to tell you much. Yeah. So because high risk projects require high returns because you're exposed more. Yeah. And that is just something that we can solve with doing probabilistic modeling. Yeah. once we have a probabilistic distribution for our internal rate of return or our NPV, we can calculate the mean and we can relate it to the standard deviation or the range, the minimum and the maximum, as a sort of a measure of the risk that is related to that value. Furthermore, if you want to compare different project opportunities or different investments, and you only have single values, you're going to choose for the highest one. However, if you get information that the risk related to those projects is different, you may switch your selection of the project. Especially if you have a threshold. Let's say in this case, the blue line here is sort of the threshold for 12% internal rate of return. Suppose that you're not accepting anything below that. Well, the blue project with the lowest average internal rate of return is fulfilling that criteria, while the red one, although the red one is giving potential for higher returns, opportunities. You see that the tail is longer here, but also on the downside. So your risk of being below your threshold criteria. So that's why you need the mean or the deterministic values by itself do not give you sufficient information to make good decisions. Furthermore, and often what I see is that then people start doing sort of sensitivity analysis if they think deterministically, and they come up with one-way or two-way data tables. But only the probabilistic modeling is going to capture all the different scenarios that can happen. So that sensitivity analysis is not equal to doing probabilistic modeling. It tells you a little bit what matters, but it does not tell you what actually is happening. And in real estate especially, a lot of the parameters that feed into your models, whether it's valuation, whether it's investment analysis, whether it's real estate development, a lot of these parameters, they move together. Because they all are driven by the same underlying macroeconomic situations. And so you need what we call correlations, dependencies. That is something that you cannot define among deterministic models unless that you start relating one variable directly to the other one in the model itself. But with probabilistic modeling, we can at least say, well, if our inflation, for instance, here on the right graph in the UK is high, then our rental income is going to be high. If it's low, then it's also our rental income is going to be low. So we can use correlations to describe the relationship between all these parameters. And this one, I'm not going to stand or explain this in detail, but what happens when you do probabilistic modeling, you can calculate option values, which is the nice thing, sort of pricing flexibility, because one of the drivers for option value is uncertainty. So if you can define uncertainty, typically by the standard deviation, then you can determine option values. And in real estate, options are something that can be used a lot, although they are seldomly priced or valued. You can acquire a piece of land, but you can delay the construction until you have certainty about certainty about the market or something. Or when you have a permit, only then are you going to pay the acquisition price to the seller or things like that. That has a value. And often people say, well, can I have an option for buying the land? But then they cannot value it because they think deterministically. So these are all nice things. And what you do with probabilistic modeling is that you can provide more correct answers to the concerns of investors, like what is the likelihood that my equity is going to be wiped out, or how much price softening for the sales prices can I allow, and things like that. So that is why we definitely should think more probabilistically in real estate. Now, let's maybe, because that's sort of the purpose of the presentation of today, let's see how we can do that and what ModelRisk can do and how it can help us with that. Before I sort of dive into the Excel sheet itself, let's maybe look a little bit on the two cases. I have a sort of an investment case and a development case. They both come from a very good book from Professor Steiger, who is related at the Johns Hopkins Business School, I think, and in his book. So, and what is nice, and before that I read his book, I also didn't think about this, but when we speak about return, we often speak, or we mostly speak about return on investment. But there is also something that is called return of the investment, meaning how likely is it that I will get my money back? That is also something that you can calculate. I'm not going to go into the details of this. That's not the topic of today, but that is a nice add-on from that book that at least I learned when reading through that book. Now, when we look at an investment case, for instance, and I called it here a valuation concept because I was looking at how do I value a potential building that I like to acquire, and that building is seen as a sort of a real estate. It's a financial asset, meaning through the real estate, through the building, it's going to generate some rental income. While operating that rental income, and you see that you may have during the duration of your exploitation of the building some increase in rents due to the inflation rate. You will have some regular expenses, and then once in a while you will have a larger expense for maintaining the building or for doing some refurbishment or things like that. And then in the end, you have the sale of the building. The sale of the building, as we will see in the next slide, is going to be based on the expected rental income of the following year. So this is sort of the concept of the model. And as you see, typically when you're doing such an investment, acquiring office buildings, for instance, or residential buildings, apartment buildings, you are projecting a horizon of easily 5, 10, 15, 20 years sometime, or even more. So that is very difficult to project exactly with single value numbers what's going to happen in the long term. And that's why you definitely need to include uncertainty if you're thinking about those long-term periods. Now, if we look at it, how does the model work a little bit? And this is for a deterministic model. You typically have the revenue, which is the number, for instance, the number of apartments multiplied by the rent, the monthly rent or the yearly rent. You will subtract some expenses, and you will have some financing costs. Like I said, at the end, whatever period you're considering, suppose we're looking at 10 years. So in year 10, you project of selling the building, that the sale of that building, what is that building going to be worth? Well, for that, you are going to look at the revenue minus expenses in year 11, and valorized using a sort of a yield factor or a capitalization rate, as we call it. And you will, of course, subtract some sale expenses at that time and the remaining outstanding debt. Because what we are going to we're going to buy a building, so that's the use of the capital. Maybe we are going to do some renovations, yeah, or small refurbishments at the time that we acquire the building. With what money are we going to acquire the building? Well, that's going to be partly equity and partly debt. Yeah. So after 10 years, we may take out a loan for 25 years, for instance. If we sell the building after 10 years, that means that we still have some outstanding debt that you need to subtract in year 10 when you're selling from the sales price of the building. Yeah. Now, if we look at the same model, but probabilistically, you will see that a lot of these variables, like the rents, the expenses, here we have sort of the how much equity do you want to put into the building? That may be a little bit variable when you're assessing whether or not to acquire the building. Yeah, you do not know how long you will keep the building in your portfolio. Yeah, maybe 10 years, but maybe 11, maybe 15. Yeah, so this may change a little bit the duration of your portfolio or acquisition holding. Yeah. The cap rate is going to be very uncertain. Yeah, you may know the cap rate at the time of acquisition, the regular cap rates for office buildings or logistic, if you're in the logistic field. Yeah, but in 10 years from now, those cap rates may be different. Yeah, so that is what's going to happen if we look at a probabilistic model, yeah, like you will see. Now, how is the model that I'm going to show you a little bit? How is the model set up? Yeah, well, we have an input sheet where we put all the information about the use of the capital, the acquisition of the acquisition price and things like that, how much equity we use, what are the rents, what are the expenses, yeah. How do we finance? The financing is calculated separately in a sort of a debt sheet. Yeah, typically in this case, it's a traditional fixed monthly amortization. Yeah, and then we have the valuation of the building. Yeah, we put that all together in a sort of a pro forma cash flow on a monthly basis, and then we summarize that in sort of our dashboard, which is more a yearly overview of the cash flows. Yeah. So that's it. I think okay. That's it. Let's just see if I can open the building. All right. You should see my Excel spreadsheet right now, I hope. Yeah. Now, what have we done? This is the input sheet. Yeah. And I hope this is large enough that you can see it. I can maybe just put it a little bit larger. So here, for instance, we have the equity, yeah, and you can see what I've done, and this is sort of hypothetical values, right? This is not. I've sort of changed a little bit the numbers here, and this is one of the cases that I often use also in my teaching courses, yeah, just to illustrate different practices of assigning distributions. Yeah, here we have a uniform distribution. Yeah, so if you go to view model, yeah, or view function, sorry. Yeah, oops. Let me see. All right. So here you see. I hope you see the pop-up window. Yeah. That. Yeah. Okay. That is a uniform distribution that you define, and you in these cells here you refer. This is what I typically like to do. You refer to the parameters in your Excel sheet. Yeah. Okay. So let's a little bit close this. I think for those of you that are not familiar with how to do that, you can just, whenever you want to assign a function, yeah, you can sort of switch on the select distribution sheet. Yeah, you get your pop-up window. That is, yeah, since I have two computers here, yeah, you get sort of, let's say that we go to the common one. Here you have the uniform, for instance. You say, okay, and then you can, it's switching all the time. That's a little bit, yeah. And you can sort of type in here the value, or you can refer to cells in your Excel sheet. That's always better to do, yeah. And so, yeah. Okay, I'm going to close this. So that is a little bit what I did here, yeah. For you see here I'm uncertain, or of course I want to minimize my equity, because then my return on equity is going to be the biggest. But typically, the banks are going to demand for approving the financing of an acquisition of a building. They're going to require that you put in a certain amount. Here in Belgium, it's typically between 20 to 30% of own equity, depending also a little bit on the risk. But so I've said, okay, let's make that uncertain just to see. I've some capital improvements, but these are rather minor. And then here I have some rents. This is a 7-unit building, very small building. I have some rents. I have some vacancies, meaning that not all the time all these units are going to be rented out. So I may, in about 5% of the cases, I may not have any income. And I have some expenses here. You see that I have my rental escalation and I have my expense escalation. And sometimes they're the same, sometimes they're a little bit different. So that is what happens here. And then here I sort of have my financing data, and my valuation data, and the uncertainty about how long am I going to consider my holding period of my building. Here in this case, my model is set up so that it can vary between 10 to 15 years. So that's a little bit the definition. And as you will see, that whenever that you run ModelRisk, what is going to happen is that each time that you, for all the probability distributions that you have defined, it's going to sample a number. I'm pressing the function key F9 here when my random mode is on here in the samples. And you see that when I switch off my sample mode, I sort of get my mean, or most likely value, and that is sort of a simulation of my deterministic case. But let's just put on those samples thing again. There's some. Okay, there you go. Now, one thing that I want to show you before I go on here is that we'll see these. Like I said, a lot of the parameters in real estate are related. And so when you're sampling, see, this sampling process is sort of a random process. When you're sampling a rent for a 1-bedroom, in unit 2, well, that is going to be a little bit related to the same 1-bedroom rent in unit 3, right? It's going to be very rare that one is going to be very high and the other is going to be very low. So that is something that you can do with correlations, and we'll see that in a moment how that works. Now let's go to maybe first the depth sheet here. Which is, then let me put this also a little bit larger because it is very small. So what we have here, these are the periods. We have a loan of this amount during 30 years at an interest rate of that amount. And you see that this is the starting in period 1. You pay some principal, you pay some interest, and that is the total payment, principal plus interest. That is fixed, same amount every month, I think it is, or every year. Let's see. It's every month. And then you see what's outstanding, and this one is going to be the start of the next period. So on. And then after 10 years, you will be looking here at 120 months then. But suppose that you're selling after 1 year, then you see that you still have this amount outstanding of your debt. So that is what is calculated here. And then everything is sort of coming together in what I call the pro forma sheet. Let me enlarge this as well. So what we see here is the revenue that comes in from all these. This is based on the rental rates, yeah. And you see that after after 1 year, you see here you have the switch to year 2. You see that prices increase or rents increase a little bit. That's due to the rental escalation. Yeah, that's happening. Yeah, you have some vacancy, so this is related to the percentage that we had defined related to that one. Yeah, and every time that you press F9, those numbers should change a little bit. Yeah, they change. Yeah, the same with our expenses. Then we have our net income, yeah, which is revenue minus expenses. And here you see the payment of your debt every month the same. Yeah, and then this one here says you're selling the building in year 10. If we go to year 10, so I have to slide to the right here. Oops, too far. Yeah, there you go. Yeah, you see here we are selling in this case in year 10. Yeah, that is the income that we get in. This is the amount of our outstanding debt. This is what's remaining. Yeah, and now if you press F9, of course, those periods are going to change. Yeah, because I said you will see that this is somewhere more to the right. There it goes. Yeah, yeah. So this every time that you press F9, oops, yeah, it's sort of at a different happening. The sale is happening at a different year. Yeah, this is 11. Yeah, and you need the net income of year 12 to calculate the value of your sale. And now, it jumps again. Yeah, so that's the uncertainty of the duration that you have incalculated. If we go to the dashboard, maybe that's a little bit clearer there. Yeah, if let's see if I can enlarge this again. Yeah, so here is sort of a summary of everything. Yeah, and again, like you can see now, yeah, you see that the periods jumping. The value is jumping and the duration of the holding period of your building is jumping. Yeah. So based on this, in the end, what we want is we want to look at our net present value calculation or our internal rate of return. Yeah. And like you see, I already run the model, so I'm not going to do that right now because of the video feed. Yeah. But if you go to the results, yeah, you can view results, yeah, and there, let's see if it opens. Yeah, there, let's just look at our internal rate of return. Yeah, there you go. This is our internal rate of return. Yeah, anywhere from, yeah, it can be quite low, up to 3%, which is lower than maybe almost some bonds from government bonds. Yeah. Or it can be as high as 10% or higher. In this case, I've not put it too low. If you say, let's suppose that you say, well, my threshold is 7. Yeah, so you can add a marker if you want. Edit markers here. Yeah, you can click on that one if it wants to open. Let's see, where is it? Yeah, there. You say, okay, add me a marker. Yeah. You can add a marker based on the probability, or in this case, what we are going to do, I want to add a marker based on, what did I say, 7%? Okay, so 7%, then you click on, all right, okay, and I'm not going, you can change the colors and everything, I'm not going to do that right now, and then you should see here is my 7%, so if that is your threshold, yeah, then now, based on the acquisition price for the building that you were assuming, you see that you have 40% likelihood that your internal rate of return is going to be below the 7%. Yeah, so that is giving you additional value to judge your acquisition or not of the building. Yeah, what you can do then is if you say this is too high, yeah, I'm only accepting, for instance, a 20% chance. Yeah, you can go back, yeah, and you can go to your inputs, and you can say here in my input, let's switch to the input sheet here. Yeah, this was my acquisition price there. Let me put this there. The purchase price of the real estate. So if I put that lower, 750 for instance, and I rerun my simulation again, you will see that that has shifted. In order to avoid a little bit too much delay when we are running with the video feed. So that's one thing that you can sort of optimize by doing that. The other nice thing is that right now, based on the simulation, you can also assess in your results, view results, instead of looking at our graph here, you can also go to change what you're looking at. You can look at different things, or you can say, insert me a tornado. And now you see that you have here all the different, or some of the different inputs that you defined, the uncertain inputs. And now you see here, and this again, the tornado, you have tornado options. And you can, let's see, where are the change chart type? I think, no, where was it again? The mode, there you have different ones. Now we have sort of the conditional mean, I think. You can go to another type of correlation, that says contribution to variance. How much is the uncertainty of each factor contributing to the uncertainty of my internal rate of return? And you see that in this case, immediately what jumps out is that there are three factors that are basically determining my internal rate of return the most. The uncertain sales period, how long am I keeping the real estate assets in my portfolio? What is my capitalization rate? So the yield at the end, what I'm using for valuing the building at the end, and how much equity I'm putting into it, of course, because the more equity that you put into, the lower your internal rate of return is going to be. So this is sort of also a valuable tool to assess what factors are driving your decision. That you want to make. Okay, I'm keeping an eye here on the time, and I want to allow a little bit for questioning as well. So I had a few more things on this one, but let's maybe switch again, and I'm going to close here this one so that we can briefly still cover the okay, don't save, development part. All right. So here, the development one is basically a little bit more complex, but basically it's sort of the model is set up in a similar way, And if you look at development, or in financial modeling in general, what you can look at is, one, you ask where is the money coming from, and the second one is, what am I going to do with the money? Well, in this case, what am I going to do with the money? I want to buy a piece of land. I want to build something on it. And then hopefully, after selling, I will have some profit. That is, I'm going to pay the seller of the land. I'm going to pay the construction company, and I'm going to pay myself. I'm going to keep money. Where is all that money going to come from? Well, what we call the investment itself, that is everything except the profit. That's no investment. That's something that you have over at the end, hopefully, if you do make a smart decision. The investment is typically consisting of three building blocks: the own equity that you put in debt, the debt, so the financing, and the money that's coming from the sale of the units that you're realizing. And the debt may be partly bank financing, but it can also be mezzanine financing, different forms. And one thing that you have to keep in mind in real estate, because everybody speaks about returns, but you have to ask yourself the question all the time, what return are you speaking about? Is it a return on investment or a return on cost, which is the same? That is sort of the ratio of this yellow profit block compared to my investment block here. That is my return on investment. My return on equity, you see that one is sort of different, the yellow versus the purple one. And that's why everybody is using debt financing in real estate, because that is sort of a form of leverage that is increasing the return on equity by doing that. So that is something that you have to keep in mind when you look at the model. And then the second thing is that for this model, the cost during the construction, you need to spread them in a way. So what we typically do is we calculate all the costs, so that we make an estimation using probability distributions of what's the total construction budget, and then we sort of divide that construction budget over the duration of our construction period. Now we can use for that what we call a levelized spread, so an even spread, meaning my total cost divided by the duration of the months, so every month the same. But in general, sort of a construction expenses, they follow a sort of an S curve, a typical normal. So it goes up slowly, and then you come to a rise, and then once your building is constructed, putting in windows, and then you start sort of the finishing, and then the cost decreases again. So that you can choose a little bit in the model which method for spreading those costs you are using. And let me see if I can open my real estate model there. And okay, let's suppose, I hope, can you see it now?
Yes, Peter. Yeah, we can see that.
Okay. Let me put this again, because I'm dragging from one to another. Okay. So here again, we sort of have the same sheet, but now you see here we have uncertainties related to the timeline of your construction or your development project, your permitting phase, your construction phase, and then the end of your sales period. And here, what I'm using is I'm sort of saying, well, these are different months. My cash flow is in months. So you need to define the uncertainties also in months. So here, if I look at my ModelRisk, the view function, you will see that is sort of a step function uniform. So it can my duration of my permit can be between 6 to 14 months. That's the uncertainty. You may get it in 6 months, but if somebody appeals to your permit, there is another 8 months that comes to the total period. So there, or another, so it may be uncertain. So that are, depending on the parameter you're looking at, you need to think about which distribution is describing my parameter the best. The same what we have here in all the cost items. You see that you have here different, and here I'm using sort of more as an illustration, different distributions. This is not to say that for building costs, typically we use a log normal distribution to describe a building or construction cost. But like triangular costs for architectural design, that's not really. It's more a PERT function. It would be better. But I'm just using here different distributions just so that for sort of illustrating those. Again, if you look at the view functions using my select distribution, you see the shape and the parameters that were used for describing that function. Yeah. And the same at the bottom for our sales prices here. Now, this may be interesting. I think I did not run this one yet. So let's see if we can run this one just briefly. I hope this is not going to take too long. Because what I want to show, and typically you get a pop-up window that shows you the progress. Yeah. What I want to show is, oops, that's not what, okay, let me close that for a moment. Yeah. What I want to show here is the sales prices, of course. You should also, we were speaking about correlations, yeah, but I think that time-wise we will not have sufficient time to illustrate it. But what I might illustrate is, let me take a cell where I can show that, or maybe here. Let me put this in here. Yeah, I can go to the where is it? The view function here. No, the quick base. Sorry. Yeah, and then advanced tools. Yeah, probability. Yeah. And there is a function that says the probability of the PERT probability. Here it is. Yeah. So what this does, yeah, PERT probability. Yeah. What do I need to do? I need to define the value, which is the specific one that I'm referring to. That one, I think. Yeah. Okay. And then the minimum, which is the one that I have here. Yeah, it's always aligned to low. Okay, the mode and yeah, all right, there, one higher. Okay, and the max. Yeah, go on. Okay, the second line, and then as cumulative one, I want to that be true. Yeah. Okay. Now, what is this going to show me? Yeah, okay. What this is showing me is sort of the percentage, if I put it in percentage, that the cumulative percentage, so this is sort of the value that appears here, is sort of the 29th percentile of the range that you defined. Yeah. Now, what you want, typically, if, let's see if I can just copy this for a few ones, because I think I need to adjust them again. Let's see if this works. Yeah, okay, okay. And then I can probably do it for all of them. Yeah. So what you see already is, well, this is 2 1-bedroom, and then we have 3 2-bedrooms. Okay. Yeah. And let's take the 3-bedroom as well. Yeah. So these are prices for different types of apartments. Yeah. You see that in this case, this is sort of one scenario, right? This is a sample. Every time that I press F9, it's sort of one potential scenario that can happen. But you see that right now, it took the 81 percentile value of this interval for my 1-bedroom. And for the other bedroom, it took the 58 percentile value of the corresponding interval. Yeah. For the 3 2-bedrooms, you see that these percentages, they are sort of differ, yeah. Especially the 4% here is low. So this is very unlikely to happen that for one of the 3 bedrooms, you will have a sales price which is at the low end, and for one, you will be a sales price in the middle end of your range, and in the other, a high end of the range. So that's why you need to include, in fact, here, for those prices, you sort of need to include correlations, which you can do by using the ModelRisk and then go to correlation, yeah, and then multivariate copula, and then you can describe a sort of a correlation matrix. But I'm not going. I see where. Yeah, I'm not going to do that. And again, once you've run your model, this development model, yeah, which is sort of here. This is here. You see sort of the levelized cost, right? I sort of switched for the design and permitting costs, and let me maybe make this also a little bit bigger. Yeah, yeah. There you see that they are even every month the same amount, while for the construction cost, which is sort of this block here, yeah, you see that that is, yeah, going up, yeah, further as you go, and of course your construction period also changes, yeah, and then it decreases again, yeah. You see that if you look at one of these lines, yeah, you see it goes up and it decreases, yeah. That is sort of the S-shaped curve that you have, and then in at the bottom here you get again, yeah, the sort of your net present values and your cash flows, internal rate of returns that you can, as a result, that you can view the results, yeah, and again here this is the project internal rate of return, for instance, yeah, you see that it starts at about 10, yeah, and it goes up to about 20 to almost 30%, a little bit higher, yeah. So that's the uncertainty for the development given all these uncertain parameters, yeah. Okay, I think maybe we'll stop here for allowing a few minutes for questions so that we can end the talk by 7 or by the time that on the hour, yeah. So Gustavo, I'm not sure, I did not watch the chat here. The slides, yeah, they can be available. I can make those slides available, yeah, no problem. Any questions?
Yeah, let's see. I have a couple, Peter, but I will prefer for our guests to send you first. We already have Josh who already wrote to me, so thank you for that, Josh. And well, this was outstanding, so thank you for that. I have a couple of questions, so maybe the participants will send us a couple later. But the one that I always had, and this is my hesitation, when I always do NPV models, right? Like the one that you did, right? IRR models. So should the discount rate use a distribution or should it be static? Because that's a question that I always get. So I would like to have your opinion on that.
Okay. The discount rate is basically something that you how should I say that either what happens typically is either people use a sort of a fixed discount rate that is determined by the organization or the company that they work for. Let's say they use standard 8% or 12% discount rate, yeah. But in reality, the discount rate is sort of what we call a weighted average cost of capital. Yeah, so that is composed of the amount that you require on the return on your equity. Yeah, and the interest rate that you need to pay to the financing. Yeah? You have what weighted average cost of capital means is that you have capital that consists of equity and debt, like I illustrated. Yeah. So the equity requires a certain return. That is something that you define yourself or the company defines. How much money do we want to return to the shareholders? What is the required return there? Yeah. And the financing, that the bank financing, for instance, that is determined by whatever percentage that the bank is going to acquire. Now, if you are in the stage of looking at or assessing an investment opportunity, some of those parameters are not yet defined. What is defined is how much return that you want on your equity, but what is the division, the ratio between your own equity and the financing? That is something, like I said, in my case, the first case was between 20 and 30%. So if that is going to vary, then automatically your discount rate is going to vary because it's the weighted average cost of capital. Yeah, and again, for the debt part, the financing, that is something that is variable because, first of all, you do not know how much financing the bank is going to allow you, and secondly, the bank is going to require a return, an interest rate, which also may be a little bit variable. Yeah. Once you, of course, are further in your project and you have negotiated with the bank, then those parameters become more fixed and then of course your discount rate sort of is going to be fixed, right? Because everything, you know how much equity you stopped in if you have bought the land already, yeah. So that is one part of the equation. The second part of the equation is that discounting is sort of a measure of the risk, yeah, for making future cash flows actual to today. But of course, the further that you go into the future, the more uncertain those cash flows come. Yeah. So some people are also using different discount rates for different periods. Yeah. And for instance, if you're looking at a development project, the construction, which is typically something that happens in the beginning of your project, it may be 3, 4, 5 years, but something that is early on in your project, that may have a different discount rate. So the costs may have a different discount rate than, for instance, the sales, which might happen after the construction, yeah, and are further in the future. So does that sort of answer your question?
Yes, thank you so much. Thank you so much, because this is the typical question that I get for when modeling NPV calculations. And the second one, I think that you've already answered, which was I was going to ask you, what are the 3 top variables that you usually correlate? Because these are the typical things that we correlate. And after that, I don't know if we have more questions, and I will let you close and say goodbye. So thanks again, Peter.
Okay. Yeah. No. Well, just on the correlations, yeah. What we typically see is that you correlate your rental or sales prices, whatever you're looking at. Yeah. You sort of correlate escalation or inflations if you're using different escalation rates. Yeah. And you correlate yields with interest rates and things like that. So it is there are quite some correlations that you need to feed into typical real estate projects. And maybe just to finalize, let's see if I can share again. Yeah, I think so. Yeah. So what I basically wanted to show you with this presentation is that we definitely, if you are in real estate and you're doing some financial real estate modeling, yeah, include your uncertainties into the model process. ModelRisk is an excellent tool for doing that. Yeah. It can also be used, the graphics. ModelRisk is very good in the generated graphics. I've illustrated a few ones. That is a very good tool to interact with your stakeholders, whether it's your investors, whether it's the government if you need permits, or whether it's your construction team, yeah, to make things better. And it's far better to base your decision based on that information than just what a lot of people still are doing in real estate, going by their gut feeling. So with that, I think I'll end here, and I'll wish everybody a nice continuation of the day, or a nice evening like me here in Belgium. And I hope to see you once more one of the future webinars or summits by VOS and by the Ferryfield Group.